This is Phillip Streible, Chief Market Strategist at Blue Line Futures, and I kind of wanted to give you an outlook on the precious metals here, kind of a Blue Line Futures metals market movers video type segment here, where we're going to focus on the precious metals, kind of the outlook, what could impact or derail this rally that we've got going underway, and kind of what propels them, what to look out for, some red flags, just kind of give you some information on those markets. So, first of all, I do contribute every week with Kitco. I write a summary on the precious metals on, different ones, whether it's gold, silver, copper, platinum, palladium, kind of wherever I think that there's a good opportunity out there, and, and kind of outline some of the different strategies or tactics that you could use, and again, the things that we're looking at that's going to most likely move that market. So the article I wrote just recently was a great upcoming gold bailout, which is just a joke. There's no way of bailing out gold. Really, you look at stocks, they've all been bailed out. It's been, a risk on sentiment, but it's really just the Federal Reserve backstopping and also, monetizing all this debt and really trying to plug all these different cracks here. So we're seeing as the balance sheet continues to increase, gold futures have increased with it. And if you look at this chart right here that we've outlined, this is kind of when you should have started to look at going long gold. That was the third quarter of 2018. The economy peaked. It marked an essential top in the cycle, the business cycle, where GDP was at 4.2%. That was a bit of an outlier. It was kind of shocking to see over 4%. And then also, the 10-years, they were up near their highs. It was like 3.25%. We were in this rate hike cycle. But the problem is all these businesses out there are continuing to take on more credit, more debt, get more aggressive. They're buying back their stock. They've got very little cash on hand. So when you do have, an event like the coronavirus where it shuts down the economy, and I was really surprised that it took that. I thought that the asset bubble would have started to pop ahead of that. You see the 10-year note, it starts to grind down. So if you look at this chart, this is kind of when we were at 3.25% back in that late business cycle. Since then, we've been grinding lower, and we're kind of stuck in this range right here, which, if you look, it's like 0.64% to about 0.71. That's kind of this range here on the 10-year note. And what it translates to is, if you look at gold, this is a 3-month chart of the gold market, and we were building up to it. So if you look back here, we're building up, everything's starting to move up, and then all of a sudden you get slammed down here. That was just a liquidity crisis. That was, oh my God, throw everything out. The baby's out with the bathwater. We've got gold plunging down here. You had lines around coin shops at this point in time trying to buy it. I was able to find some coin shops that still would sell, and they weren't keen on selling, $20-$25 silver. They were actually selling it the way they should be, which is just above spot. But Fed takes some drastic measures, starts bailing out. We see that balance sheet go from like about 3.1 trillion on up to about 7.1, and it's just exploded from there. We get up close to about 1,800, and it was a bit of a blow off top. Really, excellent move, great move, should keep going higher. But, it tended to exhaust itself, because what happened was these people that were, they bailed out all their stocks. All of a sudden you see their stocks they're all recovering, like all the FANG stocks are recovering. And then they're even seeing better opportunities. Like if you look at, gold's going to move at a certain degree of slope and speed to it and everything. And, if you're just playing it just to catch a ride, and it's looking at it like it's a Porsche, well, there's a Ferrari and a Lamborghini out there, and those are some of those tech stocks, like things like Netflix and Zoom and other stocks out there that people are trying to catch rides on. So those all take off. They liquidate gold. It comes back to support, and people say, hey, wait a second, the balance sheet's still quite high. And actually, the Fed's getting much more creative on different ways of supporting the economy. So we go into this cycle, we come back up again, and it's like they're voting on a, to add stimulus, and they do, and all of a sudden it's like, hey, people are going back in. All the Robin Hood people, they're buying Hertz, they're buying Chesapeake, they're buying, whatever they can, cruise ships, airlines, And so that's where you get gold going down. You remember, there's people that aren't like us, where like they hold a percentage of gold in their portfolio forever because they know that, the way that the path is going, again, is like this. So we're kind of back and forth here, and we've come back up to this range here. And the point is that, you know, a lot of people are asking like about committing to buying gold at this level, and I really think that really a lot of people, they already have gold, so that's why we haven't been very aggressive as far as buying it at these levels. So, you know, I'm going to pull up like a full feature chart here, and let's let this load up. So you can see gold, we're 1781. These are those three little peaks here. So this is kind of where we're at right now. It's nice that it's building a base in this level. I'm still a little bit skeptical that it might trend down. So if you recently started an account with us, you joined Blue Line, you know, we're really kind of waiting for like 1750. Now again, if you don't have any gold on at all, you got to let me know, because then, you know, we might want to add some exposure right away. But like I said, most of you already have some on, so we're waiting to use this leveraged product, but, you know, pick it up on a bit of a decline. And remember, there are multiple different contracts, 10 ounce, 33 ounce, 50 ounce, 100 ounce. So, you know, if gold pulls back to this level, we'd probably be looking at, you know, first level support, getting in, adding some exposure. Second levels, we would be closer to this like 1700. Third level would be down at 1676. You know, and then we would start looking at these 1570s. But at that point in time, we'd have to reassess whether or not, you know, the dynamics haven't changed. Because again, going back to this article, I said the two most significant risks to the bullish case are, one, a full recovery in the global economy that pushes real interest rates higher. So in other words, you know, throw out your mask. We're good to go. Let's hit the bars. Let's hit everywhere. We're high-fiving at games. We're passing a 20 down to the vendor. It's 20 people are touching it. Our beer's coming back with everyone else's cheering over the beer, and we're not concerned about coronavirus, okay? And then you get maybe some more stimulus checks from, you know, the Federal Reserve, and then, you know, everybody's out. Disney's at capacity. Chuck E. Cheese is coming back out of bankruptcy because they see a new business model. Hertz is back at all the airports. So that would definitely probably derail the gold market. Now, I wouldn't take it all the way out, but it would probably push gold back into that 1600 in a wait and see type method. So, you know, again, I just wanted to bring up, you know, this is a new video series that we're going to be doing, just kind of focus specifically on the metals. And I kind of wanted to outline gold since I wrote an article on it. I'll do another video later in the week if we do see a big movement in the metals either way. And then also, I'm going to be writing another article that I post again on our good friends over at Kitco, and you know, it'll pop up later in the week. And I'm probably going to do silver, because I really think that silver, the chart pattern, it's got a bit of a head and shoulders, so we've been pretty cautious on doing anything. If you look right here on the chart, you could see that, you know, we came up, there's this shoulder right here, there's a head right here. This could have been the other shoulder and the pattern could have been completed. What I don't like is that these other highs are not as high as these previous ones. So, you know, the problem that we have is, okay, I would add somewhere in this range, right here in this range, but this speed line, this is kind of a bit frightening, because if you get a little too over leveraged, you could really have some problems. Like if we went all the way down to here. Remember, this game is managing leverage. Leverage is risk. So we want to manage it as best we can. So we're a bit patient. But remember that futures and options trading involves significant risk of loss. It may not be suitable for all investors. And again, I'm Phil Streible over at Blue Line Futures. Give me an email. Shoot me an email, phil@bluelinefutures.com. Thanks a lot. Good luck. Good trading.